The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today from Vancouver is analyst Graham Whitcomb. Hey, Graham.
Hi, Gaurav.
How's it going over there in Canada? Have you crashed the property
little
market?
Drizzle.
Oh, little drizzle. You don't know drizzle until you've lived in Sydney. I envy. I saw someone, one of my friends lives in London, has been trolling me with pictures of wonderful weather. And there's the first time I ever thought, geez, I wouldn't mind being in London at this time. It's terrible.
Yeah, I thought Vancouver was a pretty rainy city, but nope, you guys are doing it better.
No, we're doing it well. Speaking of doing it well, we also have making his podcast debut, our newest analyst to the team, Nick Cummings. G'day, Nick.
Hi, Gaurav. Hi, Graham.
Hey. Welcome, Nick. So this is it. Here you are on the podcast.
The big stage.
Yeah, the big stage. This is it. Welcome. Many people wouldn't know about Nick. So, Nick, maybe just give us a brief overview of where you came from and what you are doing here.
Yeah, absolutely. So after high school, about a decade ago, I left Australia to go to the US for university, and I was lucky enough to get a soccer scholarship. And the thought at the time was to pursue academics, but also hopefully make a career in soccer. Unfortunately, 2 ACLs later, that didn't work out. Ooh. And I returned to Australia with a love for investing, pretty much given to me by a professor over there who was an ex-fund manager, and started working as an analyst for Oracle Investment Management. I've been there before and joining the Intelligent Investor for 6 years.
Now, I understand you were running an international portfolio before you came over to us. Is that right?
Yeah, I was doing the international side for about 2 to 3 years, and before that, mainly small Australian companies.
So, Nick, you've looked at small caps, you've looked at international stocks. What is your interest on the ASX? Do you have a particular area you prefer to work on or prefer to look at?
I consider myself a generalist, so pretty much everything except for biotechs and mining, which I'll leave to Graham and Gaurav. But no, I like looking at everything. I really like retail concepts and consumer technology. They're probably my two favourites, and probably a close third is industrials.
Interesting. Well, we can expect lots of retail. Oh, you know what? Actually, a lot of people say retail because they think they get to go out and go shopping as part of their analyst training, and I can assure you there's plenty of that happening. So that's good. Yeah, we can look forward to lots of more companies from Nick. We're going to talk about one a little bit later, Nick, which I thought was a great piece of work and introduced an interesting business into the fold. But first, Graham, let's begin with you. You've had a couple of really interesting weeks with some interesting stocks. BWX
Very interesting.
I'm sure you've been engaged with them both. BWX and MoneyMe have both had various setbacks, quite unique to them, but the result has been the same. Both stock prices have been clobbered. But I wanted to tease out the differences in what's been going on with both those businesses, because I think we can make a quite interesting point with that. But let's begin with BWX and just give us a quick overview of what's happened to cause such a dramatic share price fall.
Yeah, well, between the two businesses, I'd say that they both don't have something specific acting on them about the companies. BWX definitely does, but MoneyMe is more external factors that are influencing it. But BWX, I think, is totally human error. I don't think you can blame anything else other than
if you can call management human.
Well, yes, I don't want to be that mean, but they've definitely made some strategic errors and some very shareholder unfriendly errors, which is what really grinds at me. I mean, companies, I'd like to think, are trying their best. Managements just want things to grow and work well and to sleep well at night. But they, in this case here, they've really done shareholders a disservice that doesn't seem necessary. So I'd like to hear more from them about what was actually going through their mind. But a lot of it seems to be just that they didn't have an ownership stake in the business, that they were running it for what can preserve the business, but without much regard for the little shareholders who own it. And I think that's just a terrible way of running things, and I think it's going to come back and bite them in this case. But
we see that time and time again, don't we? That I think sometimes we put too much emphasis on the actual real ownership in equity terms, but it's more a mindset that you treat the business as if you're an owner, and which means you think long term, and every dollar allocated matters. It really is a mindset, and some stocks, some management does think that way, and some doesn't. And I think you're right. He's an example of one that probably hasn't.
Yeah, I don't think that just because a stock doesn't have management that has a large ownership stake, it's somehow uninvestable. CSL is a perfect example. Management has never had anything, any real stake in the business, and yet they've always managed it. There's just a culture of looking after shareholders. So, but this case, it just wasn't that. They've raised equity at a ridiculous price after a situation that they shouldn't have got in the first place. So that's, 2 black marks.
So, Graham, was the cause of all this problem the go-to acquisition, or is that secondary to what's actually gone wrong here?
I don't know if it was the cause. The acquisition last year, so for members who don't know about it, the company BWX acquired a 50% stake in Go-To Skincare last year, and then they're on the hook for the other 50%, I think next year by memory. But anyway, the acquisition itself, I don't have too much of a problem with. I think that it may have made some strategic sense. It was bought at a very high price. That was the only thing at the time that stood out to me as being a little bit nerve-wracking about it, but I could see how they could make the case for it. However, what we've since learned is that the company, its balance sheet wasn't nearly as secure as it seemed, that at the interim result in February, everything looked fine with the balance sheet. It actually looked pretty healthy by most retailer standards, and then by most product maker standards anyway. What happened then was management updated guidance in May, and again, everything was fine. There was no indication that the balance sheet was in any way stretched. But suddenly, this past couple of weeks, management has said that net debt has nearly tripled. So they've plowed through a ton of cash somehow in the operating company. I'm very curious at the annual result, what actually used all that cash. But anyway, they now suddenly have a much, much tighter balance sheet than it seemed previously. They didn't update shareholders on it, which is another issue. But then now they're raising equity to kind of fix that mess. And so what really disappoints me is, okay, maybe Go-To was a great business to buy. And even, we don't know how well it's going to do for the next 10 years. Maybe it was even a good price to buy it at. However, if BWX couldn't afford it because its balance sheet was going to be an issue, then the priority should have been to fixing the balance sheet. This only happened in September, the acquisition. So, that is not long to suddenly go from, we're buying this $200 million business to, we need to raise equity because our balance sheet is falling apart.
And in the interim, they've had a few executive changes. I thought it was interesting that was it the CEO who walked in the middle of that acquisition? Or just after it was completed?
Yeah, he left in January by memory and exited completely in March, I think. Yeah. He made the acquisition and then left, which, it goes to show you shouldn't always give the benefit of the doubt. When he left, there was no reason given, which was really a surprise because until then he seemed like a pretty good CEO. He'd grown the business significantly. There was he was always a good speaker and didn't have any problems with him at all. So when he just suddenly left, I was like, oh, you're kind of in the middle of this great story. What are you doing? And but no reasons were given. He just found other opportunities to see. But now it makes you wonder, with everything having fallen apart in the 6 months since, maybe he saw the writing on the wall, or there was things happening behind the scenes that we couldn't see, and he was trying to jump ship early.
That very fast deterioration in the balance sheet, that's really scary. Nick, I'm not sure if you've seen this in your time as well, but 2 industries that really stand out to me that are susceptible to this are retail with those really large lease liabilities, and I would say mining services also with lumpy cash flows, big capital expenditures as well. They seem to fold on a dime very unpredictably and often. Do you have an explanation for that? And is there another industry? Were you surprised by the very fast deterioration in the balance sheet situation here?
I don't know BWX's situation too well, but the situations you describe in retail and just contracting in general.
Contracting, yep, I think that's right, yeah.
In Australia, you've seen over the last couple of months a few of those large construction contractors privately go bust, and pretty much what they were doing was locking in 2019 contracts, but didn't adjust for the cost of inflation of their building materials costs.
Yep.
And
so you've got fixed revenues coming in and variable costs, and that's obviously when costs rise, it's a bit of a disaster.
Absolutely. And on the other side, it's on retail. You're seeing it at the moment. A lot of these retailers, if you look at their first half financial results, they're stacking the balance sheet with inventory in the hope that they can move it because they've had previously strong demand from the pandemic. But now we're entering a period of, consumer tightness, and some of those pandemic trends are trending in the wrong direction. So it'll be really interesting to see in August and the US reporting season as well, how well these guys hold up.
Graham, I find this really fascinating, actually, because I was also quite shocked by the quick deterioration. Do you have any theories? I mean, I guess we'll know more in August, but do you have any early theories about exactly what happened to that balance sheet?
Not really. I mean, they did just finish a factory, so we knew that net debt would go up a little bit because they're making final payments on the construction costs. But I mean, net debt jumped 50 million or so. So it didn't cost that much going into the factory. So there was something else at play. I mean, maybe they were purchasing extra inventory as well to transition to the factory. But again, that just seems like a very large number to use that amount to get to that figure. So I'm not sure where the rest of it really came from, unless they've had a lot of inflation in their costs. But management didn't really allude to that in any of the calls so far. So
it'd be interesting to see.
I'm very curious at the annual result to see what happened.
Just to summarize, there's a few things here you're cranky about. You're okay with the initial acquisition. Now, I disagree with you there. I don't know if we'll get into it now, but I actually didn't like that acquisition. I think GoTo was a very successful social media brand, and I think it was 4 of the top 10 products on the Mecca store were GoTo kits. But I think this is a very faddish industry, and I thought they bought a upcoming fad at the peak of its popularity, and wasn't sure that was going to be sustainable. But we can argue about that. But then on top of that, you're saying that they also made errors then in funding that acquisition, and then in fixing up that funding with a big capital raise. That's also made you cranky as well. So there's been a cascading number of mistakes from this business and a lot of crankiness. For those who don't know Graham,
of crankiness.
that's a lot of crankiness for you, Graham.
Yeah, I would like to think that I'm not that cranky, but boy, all these shenanigans have been driving me nuts. To top it all off, for the actual equity raising, they're issuing 1 share for every 4 overall. But the small shareholders are limited to buying 1 in 10. So no matter how much money you want to put into it, you can't maintain your current slice of the pie. You're going to be diluted by this capital raising.
Except if you're one of the major shareholders, in which case your stake will go
in that
up.
case you can, exactly. If you're one of the institutional ones, one of the big funds or something, then you're great. You get to buy the stock at a ridiculously low price and maintain your holding. But for everyone else, then it should have been a renounceable rights issue. It really hurts when you've lost a lot of money and there's been an error in the operations of the business. But then when they try and fix that error and they do it in a way that really hurts you even more as a shareholder, that grates. That's annoying. I agree with that. Yeah, that's what bothers me is there's no clawback for management compensation. So here is the CEOs getting $1 million a year, but they've just blown up $50 million of shareholder wealth by diluting the stock.
Yeah.
And that doesn't come out of their pay packet. But anyway, I mean, this maybe brings us into MoneyMe. It shows the contrast between managements that have a large ownership stake, which MoneyMe does. Around 50% of the stock is owned by management, whereas BWX's management has, I think, 1%. So they're approaching it. It's not always the case, but you do usually find that when management has a big stake in the company, they think a little bit more from a shareholder perspective instead of just how do they maintain their jobs, how do they increase their pay, one-sided view.
And MoneyMe has had a precipitous fall in the share price, yet the operations of the business seem to be flying. They also made their own big acquisition with Society One. Now, how was that acquisition different to BWX's large purchase? Because that was a big bite for MoneyMe as well. I think they funded that with a cap raising too. Why does that not gather your anger the way BWX has?
Well, I mean, the acquisition, I don't know. I don't mind both of them, so I don't want to.
Oh yeah, right. Okay, no, I forgot. You don't mind the acquisition.
One versus,
Okay.
Yeah, I don't see why one would be necessarily better than the other. Though you could probably, I can see how MoneyMe could use its kind of risk pricing mechanism and all the algorithms running behind the scenes to price their loans better or to get them out faster to Society One borrowers. So
and also they bought in a customer base that they didn't really have, right? I think.
Yeah, well. It seemed to me like they were just buying customers that they'll probably over time remove the Society One branding and move everyone onto MoneyMe, which I think makes sense as well.
All right, Graham. So MoneyMe's made this big acquisition. They've funded it through a cap raise as well. Their business is flying. How do you account for this really big and scary fall in the share price?
Yeah, it's interesting because MoneyMe has beaten my expectations on almost everything we laid out in the original buy recommendation has been beaten in terms of its operations, yet the share price has come down a ton. So yeah, that contrast is interesting. The difference between BWX and MoneyMe is that MoneyMe is facing this huge headwind of rising interest rates that are going to, people are very nervous that it's going to suck the growth out of the company. There could be
raise impairments at the same time. I think it's those two things.
That it could be squeezed. It's going to reduce the demand for loans and it's going to increase the risk of people defaulting. So you can understand those two worries. However, it's not MoneyMe's direct actions that are causing the share price to fall. It's just the rising interest rates. And so, yeah, we can't predict what they're going to do. If they go down from here, then MoneyMe is going to be sitting very pretty. And even if they go up, we think that it has a compelling product offering compared to the banks and compared to its competitors. I've never actually seen any financial services company that has as positive reviews as MoneyMe, which is a lot to say for a small lender. So the customers
I like the way they've gone into different niches in that lending business, which are not they're not crowded and they're not obvious. I thought they really thoughtfully deployed new products and really aggressive as well. The fact that they own such a big stake is probably it's necessary in this industry because your growth you can really decide how fast you want to grow just by making new loans, right? So you have to be very discreet in how you decide who to lend to, and the fact that they own such a big equity stake that comforts me a lot.
Yeah, me too. This is definitely an industry where you can do a lot of things now to inflate the numbers and then only pay for them 5 years from now.
That's right.
So you want to make sure that management have a reason to look after 5 years from now. And yeah, MoneyMe does. They've done a very good job so far. They've kind of stuck to their core offering of just speedy loans, basically, and then expanded that to different areas of lending, most recently into auto loans, which has been a phenomenal success. So we'll see how that does.
Am I right in understanding those auto loans are actually backed by the asset as well? So they should be relatively safe. Is that right, Grant? Yeah. Yeah,
their loan book has gone. If you looked at it a year ago, there was no asset, there was no kind of collateral that was backing any of their loans. Right. It was all unsecured. Yeah. But now I think it's around a quarter of the loan book is all backed by cars. So,
and that's the fastest growing segment. So that at the margin, that's actually improving all the time.
Yeah, it's now doing 40% of originations for MoneyMe are going through auto loans, which is just astonishing. This was a business that didn't exist a year ago, and suddenly they've just created it.
That's astonishing.
Yeah, very impressive.
It helps. I think it helps their balance sheet that new cars have stopped depreciating, which no one would have predicted that 2 years ago. But that probably helps them, I'm sure. But it's an interesting phenomenon. Nick, are you familiar with MoneyMe? Do you have any thoughts on it?
I'm not too familiar with MoneyMe. I must confess, I haven't been a big fan of the small cap lending space for a long time.
I think that's been a very good decision for a long time.
I got burnt by, Silver Chef a few years ago.
Oh, that was diabolical. We had a really close look at that, but avoided it. Yeah.
Oh, it was a shocker. And then the actual competitor who sort of kicked them out was Access Today, and they end up going belly up as well. So
yeah,
it's been
that's very different. I think when you lend, Silver Chef, for those who don't know, lent money to small businesses to help fund specifically that restaurant industry, to help fund ovens and capital equipment. And when you think about the success rate of small service food orientated industries, I think it's probably under 10%, and probably 90% failure rate. So a lot of their loans were, I think, at risk the day they made them. So very different to MoneyMe, where you've got an asset there in the car that's worth something. So your loan probably isn't at risk the same way that it was with Silver Chef. This is quite an interesting.
Did Silver Chef have a larger management stake?
I think, yeah, it did. It wasn't quite 50%. I think it was probably 12 to 15%, and the chairman, he wasn't CEO, was selling down over time. But yeah, it didn't perform well, and I agree with Gaurav that it was a hard space looking back on it. Small, medium businesses in restaurants and even commercial kitchens is just very tough.
Yeah. No, that's
but
hard.
They should have been able to price the loans. Like, that's a pricing issue rather than the businesses they were serving being an issue. So that's still
it's just hard though. I think it's just a difficult business.
Yeah. Getting to the bottom of it was very reliant on the dealers. So a customer would come in and pretty much choose the loan that the dealer would give to them, and the dealer would choose the loan based on how quickly they would give the customer financing. So Access Today came into the industry and just got in front of Silver Chef essentially at the dealer level by authorising loans on a much quicker basis. And that worked for a while, and the growth was good, but eventually those loans come back to bite you.
Yeah, you need a lot of discipline, right? I think that's where that big management stake really comes in. You need a lot of discipline to say no. It's the stuff you say no to.
Are important.
Yeah.
And Graham, the big competitor, a big competitor that I know of is Money3, which also is quite large, listed as well, large peer in the auto loans area, and they're actually doing really well as well. And that comforts me a little too. The fact that there are people actually making money out of this, and you don't need a miracle in order to actually make a return in this industry.
Yeah, I think my favorite is Money3 for a few different reasons, but it does seem to it's taking advantage of a shift in the industry just away from the top tier lenders towards these more nimble, customer friendly small lenders. So yeah, all of them have been doing pretty well, and all of them are getting much better reviews than the banks and all of the rest of them. So it's a very big industry. There's a lot of room to grow, and that's why even if interest rates continue to rise, if demand for the loans or demand for cars is going down, then we still think that MoneyMe can do reasonably well just by continuing to take market share. It doesn't have to have a growing industry to do well.
So Graham, considering where the share prices of both MoneyMe and BWX have landed, what have you learned about that we can apply to a different situation? For example, for me, I think one of the big lessons is that we should hold back our worry, our panic, and the tendency to act. Just because a share price falls, it doesn't mean the situation warrants any of those things. For MoneyMe, I'm a shareholder. I'm probably not that worried about it. That big management stake really fills me with confidence. I'd be more worried as a shareholder in BWX. And when every time they release an announcement, I just get even more worried as well. It scared me now. That's my lesson, just to be more discreet about how you allocate your panic and your worry. And I'm interested in what yours is. What have you taken away from both these situations?
Yeah, I think respecting or putting a bit of extra value on management's incentives, the stake that they have in the business is very important. mean, I appreciated all those things before this, but the contrast between these two stocks does, I think, just drive home that message that you want a management that has their interests aligned with shareholders.
And of course, we say these things all the time. We know it intellectually, but there's a difference in knowing something and then, really knowing it. And you only really know it once you've felt the force of the error. And then you know it.
Yeah, and I think also with these guys, it's a reminder that position sizing matters a lot.
That's a good point, yeah.
For me personally, BWX was my largest position, and it was much higher than our recommended one, portfolio weighting.
Well, I'm happy to say I stuck to your portfolio limit on MoneyMe. It was only, I think, 2% of my portfolio. So thank you for that very sensible advice, the one that you didn't follow for yourself.
Yeah, exactly. but it is these are the moments that are a reminder that, no matter how confident you are in the long term for the company, no matter how accurate you feel that your analysis has been, that you still need to leave room for unexpected surprises, such as management not giving you the whole story that you feel that you have, or unexpected external circumstances, as in MoneyMe's case with the sudden rise in interest rates and inflation. Those are reasons that no matter how good a bargain you think you've found, you can't bet the farm on it, because sometimes you're going to be wrong. And yeah, it means that you need to watch your position sizing, not just try to get correct how undervalued the stock is.
Nick, what about you? You've seen these two situations play out. The effects are quite similar, but the causes are quite different. What do you take anything out of what's happened here?
Oh, I echo some of Graham's thoughts on MoneyMe in terms of just having that ownership there. It seems just completely absent with BWX. Also, going back on BWX, it seems to me over the years, doesn't matter what management team comes in, they always want to do acquisitions. There always seems to be another acquisition to do. Whereas MoneyMe, for the most part, it's been mainly organic growth, except for Society One so far.
Yeah. Yeah, everyone knows that I look for hustle, this indefinable quality of management that just shows that they do things differently, quickly, and with a bit of spunk. And to me, that's probably the defining difference between these two stocks, is that MoneyMe has shown hustle from the very beginning. This one bloke has started this business, gone, found these really interesting niches, built a lot of these niches from nothing. He's got this fantastic technology behind him, a unique delivery platform. Like everything they do is just filled with hustle. And then you come across the BWX. I'm sorry, Graham, but there's just there's not a lot of hustle there. It's I know they're trying.
They've done less things more slowly.
Yes, exactly right. You wish they'd done less. That's right. Yeah. It's very interesting that, I keep coming back to that concept. It's nebulous and hard to explain, but you definitely recognize it when you see it. Now, another stock with hustle, Nick, and no one can deny this. I think there might be people who disagree about MoneyMe's hustle, and there are other stocks that are contentious, but Dicker Data is one that I really enjoyed your review of that. I think you presented that really well to the team. It's a stock that we haven't paid a lot of attention to, and it's a stock that I've missed for years personally, just because it looks on the outside like a terrible business. It should be, by all accounts, a terrible business, and yet, is it hustle that explains the difference here, Nick? Explain to us exactly how a mover of boxes that makes tiny margins, takes on a huge amount of debt, huge working capital requirements, is able to pay huge dividends, and has had a 7-8 times increase in its share price over the last few years with profit growth to match. Like, what is the secret here? What is going on?
Well, I think you said it. It's hustle. It's David Dicker, the founder, and his wife or ex-wife, Fiona Brown. They own 70% of the business. And it's a brilliant business in a poor industry is how I describe it. As you said, they move boxes, but they describe it as moving boxes with a service. So when they set out 4 decades ago, they didn't really have an idea of what they were going to do, and they eventually settled on IT distribution. They got HP.
Hang on a second, I've got to stop you there. So these guys, I find that the origin stories for businesses are actually, I think they say a lot. This is a terrible origin story, Nick. You're telling me that these two people had no idea what they wanted to do. They just stumbled across an idea and thought they'd give it a try. That's not very inspiring.
I should say they knew they wanted to get into computers, but they didn't know in what aspect. I mean, originally he was worked in his dad's, I think, roofing business. He has no university degree, and then became a coder and was a better coder than most engineers.
Wow.
And then they tried to build a computer, but that didn't work, and eventually got a contract, I think, with HP or Cisco for Australia, and became an IT.
It just says so much about, we all have this idea about what success looks like, about the kind of person we want to back. And David Dicker breaks every single rule of that idea. I think that tells you how important those rules really are. Like, we all have them in our heads, and we should all be willing to break them from time to time. I think that was my error with this one. This sounds fascinating. Sorry to interrupt. Continue.
Yeah, no, just on some of those I guess breaking the rules. I mean, his quote on the board is, "I only want people I trust on the board and that have got industry experience." So there's almost no independent directors. He pays staff, or he pays his 3 top executives based on a percentage of profit with no caps. So they're heavily incentivized to grow profit, more so than any other management team on the ASX probably.
Yeah. And that alone, those two things you've highlighted there, they break about every governance rule in the book, don't they?
Oh, absolutely. And at their latest AGM, they got a second strike and a spill motion that was eventually voted down. And I mean,
well, they own 70% of the stock, you just said, so I can imagine that didn't go far.
And I guess, shareholders have nothing to complain about. I mean, it listed in 2011 at 20 cents, and I think it's around $12 share price at the moment, and this year they're predicted to pay 52 cents in dividends.
Wow.
So it's just incredible, absolutely incredible. And they pay out 100% of net profit typically.
Yeah. I still don't understand. I think I've heard you speak about it. I've read your review, obviously, so I get it. But I need to hear from you again, Nick. So tell me how exactly they're doing this. So here's the margins are very low. And they pay out all their cash flow as dividends. How do they compete so successfully? Is it just that they've incentivized their staff really well? Is that the secret? What is the secret?
That's one of the secrets. The other secret is focus. So they're mainly competing against Cinex and Ingram Micro, who are in 150 countries, really big and really bureaucratic. These guys are owners, and they focus particularly on small and medium businesses where they have around 50% market share in Australia. So they've been able to go to these smaller, sometimes mum and dad customers, resellers, and just win their business over the years. And they can just charge a slightly higher margin for that. So around 8 to 9% gross margins compared to Cinex and Ingram Micro, who charge around 5 to 6%, because they're mainly selling
6% gross margin.
Yeah.
Wow.
So
okay.
It's crazy low, and they're mainly selling. So the big competitors are mainly selling to Harvey Norman, JB Hi-Fi, who have a lot of bargaining power. Whereas, Dicker Data is mainly focusing on small and medium businesses. The other big secret too is, it's not that Cinex and Ingram Micro have been terrible investments in themselves. I think Cinex has tripled over the last decade despite poor management. It's just the IT industry has grown at 6% compounded for 2 decades, and that flows through to these distributors as well.
Graham, did you? I bet you were. When you're sitting down thinking about the great businesses to buy, did a business with 2 competitors generating 6% gross margins, was that on your list?
It's not one of the filters I use on our selection process.
Wow. Okay. So
it does have a great story.
Yeah, it does, right? And anyone who's heard David Dicker speak is just one of the most eccentric and unique CEOs this side of Key's wheel, I'd say.
It seems like it's all working now, but it'll be interesting to know what the company does after he eventually leaves. That all those governance things, I can see how you might want to forgive them now because everything's going so well. But what happens if you get a CEO in there that's with the same structure that isn't as charismatic or, I don't know, forward thinking.
Yeah, it reminds me of, as a kid, I always used to watch Babar. Do you know that French elephant?
Oh, yeah, I used to watch that.
And I remember coming back to it as, watching it, putting it on for my own children and watching it thinking, this is horrific. He is a absolute monarch with absolute control, an authoritarian state with completely illiberal policies where this elephant lives in
trunk.
He lives in a palace while everyone else lives in the dirt. And it struck me that it
resembles the world.
Well, any structure can be made to look workable if there's benevolence at the very top, but that doesn't make the structure a good one. It just means it depends on the individual. And here is probably the same thing, There you go, Nick. I bet you never thought you could put Babar and Dicker Data in the same sentence, but here's the same thought, right?
I was just going to say it's not my era.
But it is. Babar is great, by the way. If anyone hasn't seen it, it's quite good for little kids. But it strikes me at the same point here that the structure might not work all the time and for everyone, but for the right people, it probably is. The right way to go. It maximizes flexibility and you can get things done very quick.
Absolutely. And even though there is that sort of corporate governance, dictatorship almost to a degree in the business, he has taken care of his employees over the last 2-3 decades. They're typically the best paid in the industry, and they're well incentivized to grow the business. So I do agree with Graham, though. There's massive key person risk with this business. Though he did say he will die in his chair. So,
yeah, I believe that. But I understand he's actually a bit more hands off these days. So it's not just a one person risk; it's the operation, the people around him. Actually, those top executives, they're the ones who are actually driving this business. Is that correct?
Yeah, that's correct. He's still the CEO. So how management explain it is essentially. David and his ex-wife Fiona set the overall strategic direction, and then his his chief operating officer Vlad sets the daily operations, or takes care of the daily operations, and then he's got a CFO Mary that does all the finances, and she's worked there for two decades. So there is a little bit of, I guess, there's 2 levels of management. And David doesn't even live in Australia. He spends half his year in Dubai and half in New Zealand playing with cars. So he's very hands-off. He refers to Australia as a bureaucratic mess, even though he's...
I don't think he called it a bureaucratic mess, did he? He said something a lot stronger than that.
It was a lot stronger than that. But it strikes me as funny since he's almost become a billionaire from extracting profits from the country. But anyway.
And what happens from here? I mean, you've got this very successful business now. I understand they're moving away from moving boxes and towards distributing software. Now, that was something that we talked a lot about internally. Tell us why that will be a good thing. I would have thought that there's less scope for differentiation if you're distributing software. And can they hang on to those juicy 9% margins if they're gross margins, mind you, if they're just distributing software? Is that a threat or is that an opportunity?
It's a bit of both. So obviously software being distributed through, so the old model with software was perpetual license software, which still needs some distribution. But the new model is just distributing it via the cloud. So, software as a service, those sorts of things. It's a risk, but it's also an opportunity. So the risk is that you don't need warehouses, you don't need distribution, but you still need sales. So, for example, Microsoft have a bunch of cloud solution providers or partners around the globe instead of a direct sales force. So they rely on these guys to go out and sell their software essentially. And now Microsoft software can be a bad example because it's somewhat sells itself, but think about a mid-tier player. They don't need to employ a direct sales force in every country. They can use these distributors and resellers around the globe to do it for them. The threat is once you're on a subscription, does that relationship with your reseller deteriorating? You just go straight to the source over time. and that's going to be is the threat we highlighted in the article, and the threat sort of the research highlighted as well. But how that pans out is probably going to be a big determinant on how this stock performs over the next five years.
Yeah. And what about expansion plans as well? So often we see businesses dominate a niche or do well in a geography, but then fail to replicate that overseas or when they expand.
Yeah, 100%. This is another key question because, as we alluded to, they have 50% market share in Australia in that small medium.
50? Did you say 50%?
In small medium business,
yeah. Wow, okay.
Yeah, so it's quite high. So if you break down the Australian market, the overall market, they've got about 22%. Just corporate and small medium business, it's about a third, and small medium business, it's 50%. So their expansion, they just recently bought a company called Exceed in New Zealand, where they had 20% market share. So their market share in New Zealand, combining Dicker's market share, will be taken to 28%. And the main reason for the acquisition was actually to secure a key vendor, HP, who have just a massive market share in the New Zealand corporate and government space. So they'll be able to sell HP products now to the rest of their reseller base. So that's the only expansion they've hinted at in terms of geographical. The other expansion they're doing is they bought Hills Security, an IT business, which is actually listed. It's been a terrible company over the years. They've had
is that Hills Industries? Is that the Hills Hoist Hills?
I'm not sure. They have a healthcare business and a security business. So I don't think it's Hills Hoist, but it's Stockcode's HIL.
Okay.
It's a very small business, been mismanaged over the years, and their security division has been terrible. And so that raised sort of a red flag to me. Is like, why have you bought this terrible business? But there was a lot of, strategic rationale to do so. And the main reason was they had 2,000 resellers in that Hills business that will now come to Dicker Data, and there's very little crossover. And they believe that the security infrastructure, so cameras, monitors, and all those things, will eventually morph with IT distribution, and you'll need a whole security solution, and that they'll be able to cross-sell IT products into that base. And they only paid $20 million for it. So it's sort of I think it's a heads I win, tails I don't lose much sort of play.
Yeah, fantastic. Graham, what do you think about this? Have you come across Dicker before, and has it? What were your initial thoughts when you came to this business?
Yeah, it hasn't been too much on my radar, but after Nick's review, it does sound a bit more interesting. There's the key man risk, which I think is a bit of a downside for me, and then it's I guess more complex than I just don't know the industry very well, so can't really.
You'd like it more if they had natural IT products, I suppose.
Yeah, exactly. But where's the shareholder dilution? That's what I want to know.
Yeah, I had a friend. I have a friend, I should say, he only buys stocks that are terribly managed. He has some psychological problem. He can't buy stuff that's good. Just thinks it's good. Everyone knows it. I think he wants investing to be harder than it ought to be. So he always buys these crappy businesses with terrible management. He's actually done a reasonably good job, so a reasonably good track record. But I've never seen anyone make investing so hard. And I feel as though sometimes that can be a trap to fall into, that we think too hard about this when something is just working and easy. We sometimes ignore that, I think that's the way.
There's no points for what is it? There's no points for complexity or something.
I think there's no bonus points for difficulty, right?
Yeah.
Is that what it is? Yeah. Anyway,
that's something along those lines.
We should know Buffett quotes better than that, but we mangled that one. Look, this is a fascinating business. I must admit, Nick, after your presentation and article, I added this. I've got a watch list of stocks that I now only when I buy stuff. Well, when I think to allocate capital in my own portfolio, I've got a list of companies, probably about 30 businesses on there. I'll only go to those 30 businesses. I think I've been doing this long enough now where I know which companies I want to buy and which I don't. And I only will probably buy in those 30 companies, although there's exceptions. Whitehaven Coal was not on that list. before I bought it. So there are exceptions, but I've actually added Dicker Data onto that list because I think it's that interesting, and it's been such a unlikely success story.
Oh, absolutely. And I think, I mean, we talked in the article about valuation.
Yes, that's the other thing we should talk about, yeah.
Yeah, we wanted it a bit lower. And the main reason there was there has been, because of its success, there has been a massive run-up in its earnings multiple. It used to trade on 10 times earnings in 2015, and it sort of almost got to 30 times earnings before its latest.
Is that right? 30 times?
Yeah.
For a very low margin, highly competitive. Is this probably not cyclical? Okay, so it's not that, but that's a big multiple for this kind of business.
Yeah, I mean, even though there's not as much cyclicality, there is still some. I mean, IT budgets definitely do get cut in recessionary scenarios.
Right.
But yeah, it's dropped back to 20 times earnings at the moment, which is still double what you pay for Cinex.
Is that right?
In the US,
okay.
yeah.
20 times. Okay. So what are you thinking about the price here? I mean, we're expecting, is it double digit growth you're expecting, or probably less than that?
Double digit sounds, very low double digits is about what growth I would expect over the next 5 years. And that's really made up with sort of two observations. IT industry growth is typically 5 to 6%. And even though there has been a pull forward from the pandemic, it doesn't seem to be slowing down. Every business is now a digital business. I know that's a bit of a cliche, but it's kind of true. And there's still a bit of catch up going on there. And then the other side of it is just if they take that 1 to 2% market share, which they've historically done, you can get to a double-digit growth in terms of the top line. The market's probably not as concerned about the top line, I would say. They're more concerned about, are they over-earning? Are margins going to come down? Management said that margins should stay around that 9% growth, but it's the key arguing point between investors.
So, Graham, how do you feel about owning a low margin, heavily indebted, key man risk infused business that's under threat from software, but has a reasonably good track record? You enthused? Is this the sort of thing you'd risk your capital on?
I'm sure it'd make a difference to my portfolio. I'm just not sure which direction it'll.
Yes, I think that's right.
Yeah.
No, look, as I said,
too hard basket for me, but an interesting story.
Interesting. So you haven't added it to your watch list. You wouldn't buy this one?
Not yet, but I mean, the more I learn about it, the more interesting it becomes. So that's ask me in 6 months.
Yeah, okay. We might well do that. We'll come back to it. Graham, thanks for joining us today. And you did a lot of work on over the last few weeks. So thanks for your time again. And Nick, wonderful to have you on board. Thanks for the discussion, and we'll hear more from you in the future. For everyone else, thank you for listening.